let's help people out with index funds. Can you tell us what an index fund is?
Yes, I love index funds. I love talking about it. It's like the most boring topic, and it's so boring, but so great. So basically, there's a few ways to build wealth. You basically buy things that go up in value and provide income. One of those things that you can buy to build wealth is a stock, which is basically a share of a part of a company, like a piece of a company. And so, for example, you could buy a share of Apple stock, and then that would give you like one piece, like one tiny little piece of the Apple company. And then you're, as an owner of that company, you're due a share of those profits and a share of the value of that company as it hopefully goes up in value over time as they sell their products and stuff. And so I think that's basically the stock market. You can buy and sell these shares of stocks. But that leads to a very difficult question, which is which stocks do you buy? And it turns out that's basically a near impossible question to correctly answer because the stock market is very efficient because all of the information of the world, sum total of human knowledge is constantly being priced into the stock market. So if you're trying to pick and choose stocks, you basically are signing up for spending a lot of time doing research or just gambling and then not really having a higher expected value than the sum total of the U.S. stock market. That was my long-winded way of foreshadowing here. Enter the almighty index fund. An index fund is just a very simple way to basically buy all the stocks. And index funds were introduced in 1975 by Jack Bogle, the founder of Vanguard. At the time, that was kind of a crazy idea because his compatriots who were stock pickers and stock traders, they said, oh, Jack, you're crazy. Why would you buy the bad stocks? And he said that since the market's efficient, the best way to return as much value to the individual investor as possible is to eliminate all the costs associated with picking stocks and day trading and all this stuff. So you can basically just buy all the stocks, you you diversify away all risk of owning individual stocks, and then you maximize your own gains by guaranteeing yourself your fair share of the stock market. So yeah, it's just basically a big bucket of all the stocks. And it's also what's called market cap weighted. So you have the biggest stock, the second most of the second stock. So I picture like a long bar chart with like Apple and Amazon and Facebook and all the big companies at the big end, and then there's like this long tail of all like the several thousands of stocks in the stock market. That's what index fund is.
Oh, I love it. Well, you started off by saying it's a boring conversation. So why do you say that? I mean, it sounds pretty great. You get to own all the stocks.
Because it's not that interesting, right? There's no sex appeal. There's no one ever became an overnight millionaire by buying all the stocks, right? People, you see the headlines with like GameStop or Bitcoin or lottery winners or this crazy exciting stuff, these like really rare, really unusual, basically almost entirely lucky circumstances. And as like a casual observer of investing, you are drawn to those stories. Like, oh, if someone got rich with GameStop, should I be looking for the next GameStop? And the answer is no. You should be guaranteeing yourself your fair share of the total market growth by buying an index fund. But it just doesn't make headlines because just, I made a post earlier this year where if you look at the super hot stocks of 2020, like Tesla and the ARK ETFs and Netflix and, some of these other hot stocks, they're all down about 20% this year. Meanwhile, index funds are up about 20% this year, and the index funds have averaged about 10% over the course of the stock market. And so they just don't make headlines because they just do the same thing each and every day.
That's incredible. Yeah, I mean, I'm sort of asking that in jest, of course, but I mean, I would love for index funds to have that sex appeal, and I don't know, maybe it's conversations like this that'll continue getting us there over time period, Jeremy. But if we talk about as a long-term investor, if you're a long-term investor and you're trying to, secure a safe retirement or set yourself up for an early retirement or something like you did, talk to us about why index funds beat out individual stocks.
So, index funds are made up of individual stocks, and on average, they do the same as all the stocks. That's what an index fund does. So if you could like magically buy all the stocks, in proportion to their size of their company, like I described, then you would have essentially created your own index fund. And so they don't really beat them, but what they do is they guarantee you your fair share of all that stock market growth at a very low cost. What you do beat is basically the risk-adjusted performance, right? So if I were just to buy 3 stocks, those 3 stocks are no more likely or no less likely than any other 3 stocks to outperform the stock market because the market's efficient. We can't know which stocks are going to outperform looking forward. So if I just bought 3 stocks, what I've done is I've given myself the same expected return. I expect those 3 stocks to perform about the same as the total market since we can't know that they're going to outperform, but I've endured much higher risk and volatility. If one of those 3 stocks goes out of business, for example, sometimes companies go out of business. In fact, we are both from Southeast Michigan, and I lived in Ann Arbor for 12 years, and there's this big, beautiful bookstore that started in Ann Arbor called Borders Books. Huge company, national presence, hugely profitable. And then, the internet kind of came around and Borders was not agile enough and they went out of business. And so if Borders was one of the 3 stocks I owned, a third of my portfolio would go to zero. Right. And so when you own individual stocks, you're basically just exposing yourself to this risk of individual stock ownership without a higher expected return. And in investing, if you're accepting more risk and not getting a higher expected return, that's a bad deal. Yeah. So that's why I don't own individual stocks.
Got it. I mean, it sounds like you could be successful with individual stocks if you paid a lot of attention to what was going on a daily basis. Would you agree?
I wouldn't agree with that. I wouldn't say that the amount of attention you pay has any impact on how likely those stocks are to perform. I think that, they've even done studies. People, there are people whose lives are based on picking and choosing individual stocks. They're mutual fund managers. They will take your money. They choose the stocks for you. They return the gains back to you minus their fees. Their entire purpose of being is to read the Wall Street Journal front to back every day, know the CEOs, do the analysis, understand all the cap tables and the market or the cash flows and the EBITDA and everything to do with these stocks. And the studies show that they're no better than random at picking stocks. And so when people say, oh, you got to do a lot of work to get to beat the stock market, I basically disagree with that because everybody is doing that work. And so if you also do that work, you're just competing on this level playing field when you could just buy the entire playing field and not do the work.
I love the Bogle quote, "Don't find the needle in the haystack, just buy the haystack." It just sort of sums it all up, and it just keeps things simple. So as far as simplicity, I guess my point in that question is a lot of the folks that listen to our show are busy parents, or they're busy folks in their community, or they want to be a part of other things besides, looking at the stock ticker every day. So when you think about solutions like index funds, it has almost a set it and forget it kind of methodology. Would you agree?
Definitely. In fact, this is one of my favorite statistics. I can't actually verify whether or not it's true. I would love to just be one of those people who spouts things and doesn't know it's true, but I'm going to tell you what it is because I believe it to be true in my heart, even if I can't find a source. So there's this rumor that I can't find on Fidelity's website, but that Fidelity did a study that looked at the most successful investors, and they're trying to find the demographic of which investors of theirs are the most successful. Is it based on education, based on age, based on location, based on their experience, based on their past performance, all these different things that could impact how good you are at picking stocks. They found that their most successful investors were a tie between dead people and people who forgot they had an account. And it just goes to show that the set it and forget it mentality isn't just a convenience, although it is convenient. It's literally better investing because all of that guessing, the stock market's going to have a bad, inflation's coming. Oh, I heard the stock's good. all that's guessing. And when you're trading is more likely to hurt you than help you because there are algorithmic traders in the market that have PhD computer science majors who are writing algorithms to make trades in a thousandth of a second. And when humans have this gut instinct, oh, there's inflation coming, I'm gonna make it, they already have made those trades, and you're basically getting hurt by trading anything inside your portfolio. So just putting money into your investments, setting it automatically, and leaving it for long periods of time is how you optimally invest.
I love it. Well, let's talk about that specific question we talked about at the top of the show. How can we become a millionaire through index fund investing? And it sounds like your first step is start, and then maybe the second step is don't do anything after that. What else would we add to this equation?
I mean, you're smiling and laughing as you say it, but it's really true. And this is my entire purpose of being is just basically letting people know that this simple approach is actually the most optimal. And so I'm a nerd. One of the things I do is like pour over stock market data, historical stock market data. And so one of the things I did is I downloaded the last 150 years of the US stock market data. And I looked at how much money do you need to invest to become a millionaire? And there's basically no date in history in which you could start investing where $250 a month would not make you a millionaire over the course of 40 years. So if you put in $250 a month into an S&P 500 index fund and just set it, on day one, you set an automatic contribution. 40 years later, you'd have on average 1.9 million. The worst that ever performed, I think, was actually right at the bottom of the financial crisis in 2008, and you have like 1.2 million. Although if you held it for a few more years, you'd have like 3 million. And then the best it performed was actually the peak of the dot-com crash or the dot-com boom, which was like 3 million. And so, no matter when you start and stop, just $250 a month turns you into generally a millionaire or multi-millionaire over the course of 40 years. That's how to become a millionaire by index fund. And I'm talking about $250 a month. If you want to have 10 million bucks, you can do $2,500 a month if you can, swing that.
That's incredible. Yeah, I mean, it's as simple of a math problem as you're describing, and it just takes time. And then talk to us about compound interest. Well, why is that so powerful in this equation?
So compound interest is basically the magic that makes this happen. So and the magic takes time, and no one wants to hear that. And I know everyone wants to get rich quick, but the problem is there is no get rich quick. There's like get rich slow or stay broke forever. And when you accept those are your two options, get rich slow actually is pretty great. And the lottery winners and the super rare Bitcoin, like the thing that those things that make story like or headline news, it's because they're exceedingly rare and they're not reproducible, right? Like they're just lucky. It's just like winning the lottery. Just because someone wins the lottery doesn't mean you should win the lottery. You should play the lottery. In fact, like lottery players are overall very broke people who don't understand math well. So compound interest, to answer your question. So basically, but it takes time. So like let's say you're putting $500 a month away. That's actually the $500 a month is $6,000 a year. That is the maximum you could put into a Roth IRA, as it turns out. In your first year of putting $6,000 away, if you get 10% rate of return on that, you would make $600. So $6,000 invested is $600. So that's not that exciting. Free $600 isn't bad. At the end of the year, you have $6,600. But let's look at what happens in year number 2. In year number 2, if you do the same thing, you put away another $6,000. You actually make $600 from your interest from the money you put away that year, but you make 600 more bucks from the interest on the money you put away last year. That money that was just sitting there from last year doing nothing pays you again. And then this is where the magic happens. That $600 that you made in interest from last year, remember that interest? You get another 10% of that, which is $60. So in year number 2, you actually get $1,260 in interest. And because it's the interest from this year plus the interest from last year plus the interest on the interest from last year. And so that word compound means the growth turns into more growth. So your money is making money, but the money that your money made is making money. And so it's a snowball effect. And if you continue that forward, after 10 years, you have, I think, about $100,000. And then after 40 years, you have about $2.9 million. And so early on, most of your wealth is from what you're putting in. But the longer that you stick with it, the more that snowball effect happens. And the bigger the snowball gets, and the more of your wealth comes from the growth of the growth.
Excellent. Well, I understand you have an online course that helps people get started with index fund investing. Where can somebody access that?
Yeah, I hate selling something, and in fact, I didn't ever plan on selling something because I don't want to be giving sales pitches. And so for 2 years, I was running this Instagram and just effusively helping people as much as I could. And I would constantly get this question, which is like, how do I buy an index fund? Which I have posted several times. It's on my Instagram. It's on my website. I think people just really want what's the A to Z? Walk me through. And so I created a course, and I was going to give the course away for free. I was like, all right, here's the course A to Z. But then the business person in me knows that people don't value things that are free. And if you gave someone a free course, they would not finish it or they'd bomb out of it. And so I was like, all right, what if I charged a nominal amount for this course? Then if people buy into it, then they would feel the need to finish it because that's how, irrational, economics work or whatever. And then also I could use that money to not have this being a money. I was losing money essentially because I was paying for, all sorts of stuff to run the site and everything. And also I could hire someone, which I've done now. So now there's 2 of us making content, stuff like that. So yeah, there's a course. It's $79. Normally these courses are $1,000 or $300. I try to make it really a modest cost. and we'll probably save you hundreds of thousands of dollars in fees and stuff.
Excellent. Well, you guys will not regret following him on Instagram and consuming all this great knowledge that he has. Jeremy, thank you so much for your time today. I appreciate it.
Thanks for having me, Andy. Thanks for the great questions, and nice to talk to a fellow Michigander.
Absolutely.